Japan's stock market has broken through record highs, but the real beneficiaries may not be exporters or tech giants, it's the brokerage firms. In this video, we'll dive into 3 names investors need to know: Nomura, Daiwa, and SBI. So why is Japan booming now? First, foreign investors have returned in force. In the first half of this year alone, overseas funds poured more than 6 trillion yen into Japanese equities, one of the largest inflows globally. Second, Japanese households are investing like never before. Thanks to the new NISA program, every citizen can now invest up to 3.6 million yen per year tax-free. Millions of new brokerage accounts have been opened, especially at online brokers. Third, corporate governance reforms are unlocking value. The Tokyo Stock Exchange has pressed companies trading below book value to restructure and improve profitability. As a result, more firms are canceling cross-shareholdings, buying back stock, and raising dividends. And this rally is very different from the 1989 bubble. Back then, valuations reached unsustainable levels. The average price-to-earnings ratio was above 60. Today, Japanese equities trade closer to 14-15 times earnings, in line with the US and Europe. With corporate profits at record highs, a weaker yen supporting exporters, and the Bank of Japan exiting negative rates slowly, investors see Japan as both undervalued and fundamentally stronger. Let's start with Nomura Holdings, Japan's largest brokerage firm and one of the most recognizable financial brands in Asia. Nomura has a history stretching back over 100 years, and today it combines domestic scale with international presence. In the first quarter of 2025, Nomura's net profit jumped 52%. The wholesale division almost doubled profits, reaching 41.9 billion yen, while retail business also saw strong growth thanks to higher equity trading volumes. Its asset management arm continues to expand globally, with new funds targeting ESG and technology sectors. Nomura also has a long history of bold moves. It acquired parts of Lehman Brothers in 2008, giving it a foothold in the US and Europe. After setbacks like the Archegos collapse in 2021, Nomura tightened its risk controls and rebuilt investor trust. Today, it is once again a serious player in global investment banking. With operations in over 30 countries, Nomura benefits not only from Japan's rally, but also from cross-border M&A, debt issuance and bond trading worldwide. Its strength lies in scale, global connectivity, and the ability to capture both retail and institutional flows. The risk: heavy reliance on global markets means that a US or European slowdown could hit revenues. But for investors looking for international exposure, Nomura remains Japan's true global brokerage powerhouse. Next, Daiwa Securities Group, Japan's second-largest brokerage. While not as international as Nomura, Daiwa has carved out its strength in retail services and IPO underwriting. In its latest results, Daiwa reported a 30% year-over-year increase in net profit. Assets under management continue to grow, reaching record highs as more Japanese households shift savings into investments. Its retail client base now numbers over 6 million accounts, supported by one of the largest branch networks in Japan. Daiwa is also a leader in IPOs. It has managed offerings for some of Japan's most talked-about companies in renewable energy, semiconductors, and fintech. In fact, when a high-profile startup goes public in Japan, there's a good chance Daiwa is one of the lead underwriters. Beyond IPOs, Daiwa is building strength in sustainable finance. It has underwritten a growing number of green bonds and has launched ESG-focused funds to attract institutional investors who demand sustainable investment options. The trade-off for investors? Daiwa is more domestically focused and less diversified internationally compared to Nomura. But its stability, deep retail base, and dominance in IPOs make it one of the most reliable ways to benefit from Japan's market boom. Finally, SBI Holdings, the disruptor of Japan's financial industry. Unlike Nomura and Daiwa, which rely heavily on traditional brokerage and investment banking, SBI has built an empire around online trading and financial innovation. In 2025, SBI's net income surged to 162 billion yen, a sharp rise from prior years. It dominates Japan's online brokerage market, handling millions of retail accounts and the highest trading volumes in the industry. Its low-cost model and user-friendly app have made it the go-to choice for younger investors. But SBI is much more than a brokerage. It is aggressively diversifying into crypto assets, with partnerships involving Ripple, and reports of interest in acquiring Bitflyer, Japan's largest crypto exchange. It has also invested in biotechnology startups, fintech ventures, and even energy projects. Perhaps most uniquely, SBI is reshaping Japan's regional banking sector. It has invested in smaller banks such as Fukushima Bank and Shimane Bank, providing capital and digital transformation support. Through these alliances, SBI is building a nationwide financial ecosystem that goes far beyond stock trading. SBI is also linked to the Osaka Dojima Exchange, a project to create a global hub for derivatives and digital asset trading. This could put SBI at the forefront of Japan's financial innovation. Of course, the risks are clear. With aggressive diversification comes volatility, and exposure to crypto markets could be a double-edged sword. But for investors seeking growth and disruption, SBI represents the boldest and potentially most rewarding bet in Japan's financial sector. Let's compare. Nomura provides global scale and strong wholesale business. Daiwa offers stability through IPO leadership and retail dominance. SBI bets on innovation, fintech, and disruption. For investors, Nomura suits those seeking global exposure. Daiwa fits stability-oriented portfolios, and SBI appeals to risk-takers chasing high growth. Looking ahead, conditions remain favorable, but there are different scenarios investors should watch. First, monetary policy. The Bank of Japan has started exiting negative rates. If rates rise further, banks and brokerages could benefit from wider lending margins. But at the same time, higher borrowing costs might slow equity trading. So the balance between growth and stability will matter. Second, the global picture. The US election and trade policy remain a wild card. Tariffs on Japanese exports have already been reduced from 25% to 15%, giving manufacturers and exporters a boost. But if policies shift again, volatility in Japan's stock market could spike, directly impacting brokerage revenues. Third, Japan's IPO pipeline is expanding. More technology and green energy startups are preparing to go public, creating a fresh wave of listings. Each new IPO means advisory fees, underwriting profits, and more trading activity for Nomura, Daiwa, and SBI. Finally, Japan is repositioning itself as an Asian financial hub. With Hong Kong facing political uncertainty and Singapore attracting global capital, Tokyo is working to compete by improving governance and market access. If successful, this could bring a new wave of foreign listings and long-term growth for Japanese brokerages. The bottom line, whether through higher interest rates, new IPOs, or Tokyo's financial hub ambitions, Japan's securities firms are well positioned for the next phase of growth. Japan's stock boom is not a mirage. It's backed by profits, reforms, and inflows. And brokerage firms are some of the clearest beneficiaries. Whether it's Nomura's global reach, Daiwa's stability, or SBI's disruptive growth, each offers a unique way to invest in Japan's momentum. Which one would you choose? Subscribe to Sakura Stock to discover Japan's market gems every week.